Welcome to A Random Talk Down Quant Street. This new series takes you behind the scenes of quant investing, breaking down complex ideas, and asking the questions you've been afraid to ask. Capturing quant alpha requires a blend of innovation and precision. In today's episode, we welcome Vania Sulman back to explain how Robeco captures quant alpha. So let's get into it. Hi, Vania. Welcome back.
Hi, Erica.
So, Vania, what is quant alpha?
Yes. Quant alpha is essentially the excess returns of the portfolio on top of the benchmark returns. How do we get these excess returns? So these excess returns are generated by the quant model. What is the quant model? So we're really giving away the secrets here.
I want all the details.
That's why we're here. So the quant models comprise of factors. So we capture the alpha by means of factors. We talk about quality, value, momentum, analyst revisions, which are really the factors that make up the quant model.
Okay.
So we identify stocks that rank well with respect to these factors, and we believe that these stocks that rank well on specific factor, these are really the stocks that are going to generate that excess return. So let's take an example, value, for instance. We believe in value. So stocks that have attractive valuation, we believe they are going to perform better in the long term.
Okay.
So in our portfolio, we try to make sure that we are exposed to those stocks that rank well on value.
Okay.
So similarly goes with momentum. So stocks that perform well in the past will perform well again in the future, in the long term. So what we try to do is, again, make sure that our portfolio is exposed to those stocks that rank well on momentum.
Okay, so you've described that process of ranking, so your model. So you've got your stocks identified. How do you put them together in a portfolio? Because presumably you have to make a decision on weighting.
That's correct. So essentially, it all boils down to portfolio construction. This is something that we have built in-house, and we have refined it over the last 20 years. The portfolio construction algorithm is something that we are quite proud of. So essentially what it does is it tries to maximize expected return, expected alpha, in the most risk-efficient and cost-efficient way possible. So we're talking about transaction costs, we're talking about liquidity, we're talking about turnover. All of that are put kind of together, making sure that in the end, the portfolio consists of those stocks that, rank well on those factors, but at the same time, we take care of risk, we take care of costs. And if it applies to the clients, if let's say client wants to integrate sustainability, that can also be integrated into the portfolio construction part.
So taking one element there that you referred to was risk, you said being efficient with risk. But we're also talking about active quant here. So with a higher degree of activeness comes more risk, presumably. So how do you manage that risk?
Yes, absolutely. So risk management is really paramount when it comes to active quant strategy. In fact, if you talk about active quant, you should be talking about risk, and you should be talking about risk management. Those three things should always belong in the same sentence. So we take risk seriously at every step of the way. So from the variable definition, we make sure that we step away from unrewarded risk. So risk can be rewarded and risk can be unrewarded. Rewarded risk we like. We want to take risks as long as it's rewarded, right? But risks that are unrewarded, that's something we don't like. And we want to step away from that. So again, from the variable definition, we make sure that these biases, this unrewarded risk, are stripped off. And then we take one step further, and that is then the portfolio construction. We take risk along with the other objectives of the portfolio. And for that, we also have our risk model that is built in-house within these walls. So this risk model, so first of all, we tackle that, static risk. So that is by means of making sure that we deviate from the benchmark, but with certain limitation when it comes to regions, sectors, countries, individual positioning. But those are static risk. We can also talk about dynamic risk.
Okay.
Risks that essentially vary over time.
Okay.
So we can think about interest rate risk, or commodity exposures. These are dynamics. This can change from time to time.
And very difficult to put into a model.
That's correct. And for that, we built this risk model to essentially capture those risk factors that vary over time. And then again, directly addressed in the construction of the portfolio.
Vania, thank you so much for coming in and helping to demystify quant for our audience and for me, of course.
My pleasure, Erica.
Thanks for tuning in. Next time, we'll talk to Jeroen Hagens on how an asset allocator might typically use active quant in their portfolio. Stay connected and don't forget to share the series.